What's going on, everybody? Travis, the Stock Geek here. And today I actually want to talk about the crude oil market because what happened in crude markets today was wild. And frankly, a lot of people don't really understand it. And so I want to explain what's going on underneath the surface, and hopefully it will help some people even potentially avoid financial ruin. Today was indeed a historic day in the crude oil futures market. The front month contract, which expired today, the May contract, crashed to below zero. In fact, it went to like negative $40 a barrel at one point. We saw headlines from media outlets like CNBC saying crude crashed. It was down more than 100%, which I didn't even really know was mathematically possible. But certainly this was a wild thing. It freaked a lot of people out. It was trending on Twitter, and people were making some crazy claims out there about putting oil in their swimming pools, or that financial markets were all of a sudden doomed. I actually tweeted out that, and this was before it even hit the low of the day, but I was tweeting out earlier, ignore the stupid and misleading headlines about crude oil trading at less than $5 a barrel, because what was actually happening in the market was an anomaly around the May crude oil futures contract specifically. So I'm going to explain what I mean by that. Why was the price misleading today? Well, the reason I think it's an anomaly in the crude futures market is because the decline happened specifically in the May 2020 futures contract for crude oil. Crude oil overall is not free or cheaper than free if you want oil going forward into the future. And the market is functioning for the most part correctly. So why did the May futures contract go down so much? Well, first you have to understand the structure of the crude oil future market. Actual producers of oil and actual users of oil, such as refiners, airlines, chemical companies, et cetera, use the crude futures market to sell their future production or hedge their future needs at known prices way ahead of time, hence the word futures. So crude futures mainly exist so producers and consumers of crude oil can transact with standardized contracts quickly and efficiently over electronic exchanges like the CME. And that's where these crude futures actually trade and are quoted. So the crude oil futures contracts themselves have physical settlement. That means there's a requirement to deliver or take delivery of actual barrels of crude oil at the time of the contract's expiration. So there's separate futures contracts for different dates that represent when the contracts are finalized and when the oil gets delivered from the seller to the buyer. You can see that here on the CME's quotes. You can see that there's a contract for May, a contract for June, contracts going out to 2021, 2022, 2023, 2024. So this gives producers and consumers of crude oil the ability to hedge future production or sell into future production at dates well into the future. And you can see here that, again, May is an anomaly. It's the only one trading with a negative value. June's positive at over $21 a barrel, July at $27 a barrel. And as you go out further into the future, the crude oil prices for delivery out into, say, December 2020 or 32, and even out as high as like $40 a barrel by 2023 or 2024. So again, you can also view this on a futures curve. This kind of graphs each month, month by month, and you can see that most months beyond May are at really nicely positive levels above $20 or $30 a barrel. Now, obviously, this is lower than it was 6 or 12 months ago, but again, we don't see most of the futures contracts in crude oil trading at negative prices. Now, the standardized futures contracts also have very specific rules around how the contracts are settled and where the oil gets delivered. You can actually see those delivery instructions on the CME's website, again, for the crude oil futures contract. If you look under contract specs, you can see how the contracts are actually set up. And then if you go down to delivery procedure, you can see that delivery has to get made at a pipeline or storage facility in Cushing, Oklahoma, specifically, with some other stipulations there. So again, you can't just take delivery of crude oil on your front yard or in your swimming pool. You can't even negotiate to have it delivered by truck or anything like that. The futures contracts call for delivery at that specific place with a storage facility or a pipeline. Now, financial players like hedge funds and investment firms and even individuals like us, we're allowed to transact in this crude futures market. But since most of us don't have pipelines or crude storage available to us, we can't hold futures contracts to expiration. We have to do what's called a roll. Rolling means that we sell the contract that is getting close to expiration and we buy the next month out, so we avoid having to make or take delivery of actual crude oil. Now, there's many buyers and sellers in the crude market that similarly roll their exposures. So for instance, before this May contract expires, a lot of these participants rolled into the June contract. So the May contract actually expired today, and most players had already rolled their exposures into the June contract as of last week. You can see that the volume in the June contract is actually much higher than the May contract, and open interest and things like that are much higher already on these further out contracts. Most of the participants in the market didn't want to be stuck in the May contract at expiration. So there were some remaining stragglers or perhaps new buyers in the May contract today, and that's what created this anomaly in the May contract. So again, anyone sitting in this May contract as of expiration needs storage and Cushing to take delivery of actual oil. But guess what? There's no available storage right now. And that's because the crude oil market is currently in oversupply. Obviously, with coronavirus shutdowns, demand has gone way down, but producers haven't had time to pull back supply as quickly yet. So producers have been filling up storage facilities, pipelines, tankers, you name it, so that they can sell that oil later when demand returns. Bottom line is storage is basically full in the short run. That means buyers in the May contract have nowhere to go with their oil that they must take delivery of. And so ultimately that means the buyers evaporate. Only sellers are left in that May contract. And so when you have a lack of buyers and only sellers, this is what can happen if prices are allowed to go negative to really any value. And liquidity, again, was actually quite low on this contract. There were some people that tweeted about this, like Shy Girl, who's an expert on the crude market. She showed that there was really almost very little volume on this contract during the day. So it's important to understand that. And like I said, the June volume and open interest is much higher than May. But of course, the media is going to report the shock headlines of what happened in this very thinly traded May contract that was just about to expire. But the truth is very, very few people actually transacted in the May contract. Now, it is likely that some people maybe saw the single-digit crude prices early on in the day in this May contract and got confused or didn't know the structure of these contracts. And so they tried to get exposure and they bought up the futures contracts, which actually trade with margin requirements. And maybe they get either margin called or liquidated as the price fell further. And so those buyers quickly became sellers and again, just piled onto the sell side with no other buyers left. And so the price could just massively collapse. So it's also possible maybe some trading firms were caught on the wrong side of this and got margin called. There may be some firms that got taken out. We don't yet know. But there were other people that also saw these headlines about crude oil and tried to play the rally in crude through an ETF that's popular, the United States Oil Fund. You can see it was actually the most active traded stock or ETF in the market today. USO is US Oil Fund, and it provides exposure through an ETF to crude oil prices. The actual holdings of USO are, in fact, crude oil futures. I mean, luckily for USO, however, they have already rolled to the June contract as of last week. So the majority of holdings for USO are the June and July crude oil contracts. Now, USO, although they rolled their exposures last week, it means that buyers of USO aren't getting exposure to negative crude prices or single-digit crude prices. They're getting exposure to the June and July prices, which again are above $20 a barrel. So if you're buying USO, you're not buying oil at a negative price or $1 per barrel. You're buying it at 22 or 27. And so that is really key to understanding what you're getting exposure to in USO. The other problem with USO is that the futures curve makes it expensive to roll their contracts at higher prices each month. So that means every month it costs them a little bit more to roll into the new futures contract. And historically, this means that USO has had a worse return than even crude oil returns. So some people have pointed that out. Eric here have pointed out that in 2015, for instance, the spot oil price recovered 50%, but USO was only up 6% during that same time frame. On certain days, it was tracking a little bit closer, but over a longer time frame, you can see that USO really underperforms crude itself. So USO is not a great vehicle for exposure to rising crude prices, even if that's your longer term view. So what happens next? Tomorrow, you're probably going to see headlines of crude prices spiking massively as the May contract expires and the front month becomes this June contract, which is currently trading at $22 a barrel. So we go from single digit or even negative prices all of a sudden to $22 a barrel on the front month. And the media is going to jump all over that and say that crude spiked, tens of thousands of percent from negative prices to positive prices or whatever they're going to say. But just ignore that. It's all noise. That's also misleading. The market is still oversupplied until the economy works its way out of the shutdown and crude inventories that are in storage get worked down. So we could see the June contract see similar issues as the May contract in a couple weeks when it gets closer to expiry. But of course, people are now expecting that. So this could just be a minefield of volatility over the next few weeks. USO, again, it's still going to face issues with its roll, and it could even be a zero if it doesn't roll and this June contract gets crushed. So with all the futures markets showing volatility, I'm not sure that I would try to play in the crude futures market if you were just an individual, because the people on the other side of these trades are very sophisticated players like energy companies and airlines and chemicals companies and hedge funds. And so they know this market very well and they understand the details. So you just really have to be careful here with crude, even though it may look like an opportunity, it's a potential minefield for a lot of us individual investors. So hopefully that's helpful. And if you have any questions, hit me in the comments.